The global silver market is entering a dangerous phase, as China suddenly halts silver exports, triggering panic across financial institutions, industrial buyers, and precious metals investors worldwide. This decision arrived quietly, without headlines or warnings, revealing itself through delayed shipments, broken supply chains, and rising anxiety inside international commodity trading desks. Silver, long ignored beside gold, now reveals its true role as a strategic metal powering energy systems, military technology, and the global digital economy. China controls a massive share of global silver refining and processing, meaning any export restriction instantly shocks markets across Asia, Europe, and North America. Within days, silver premiums surged, futures markets destabilized, and analysts rushed to understand the true meaning behind China's sudden move. Officially, China claims the export halt protects domestic industry, but beneath the surface, a far more calculated economic strategy is unfolding. Silver is essential for solar panels, electric vehicles, defense electronics, medical equipment, and semiconductors, industries China defines as national priorities. By keeping silver at home, China secures its green energy expansion while reducing exposure to foreign supply risks. Foreign manufacturers now face a brutal reality, competing aggressively for shrinking global silver supplies at rapidly rising prices. This sets the stage for a global price war, with analysts warning silver could surge toward the critical $63 level. Unlike gold, silver markets are thin and heavily leveraged, making them extremely vulnerable to sudden supply disruptions. For years, paper silver contracts multiplied far beyond physical supply, masking real shortages beneath artificial price suppression. China's export halt rips away that illusion, forcing markets to confront physical reality. Industrial buyers now rush to secure long-term silver contracts, regardless of cost, fearing production shutdowns. At the same time, investors finally recognize silver's strategic scarcity. Western governments grow alarmed as silver shortages threaten renewable energy targets and defense manufacturing schedules. Solar panel manufacturers depend heavily on silver paste, with no immediate substitute capable of matching efficiency. Electric vehicles require increasing amounts of silver for power control and safety systems. Military electronics rely on silver's unmatched conductivity under extreme conditions. Every sector fighting for silver tightens the global supply squeeze. China's timing is precise, as global silver inventories were already dangerously low. Major vaults report declining stocks while delivery delays stretch longer each month. Futures markets signal backwardation, where immediate demand overwhelms future supply. Historically, such conditions precede violent price movements. Silver's calm surface is beginning to crack. Some analysts believe this move is not only industrial, but deeply monetary. For thousands of years, silver served as money during periods of currency instability. As global debt explodes and fiat currencies weaken, strategic metals regain importance. China understands this historical pattern better than most nations. Restricting silver strengthens China's long-term economic leverage. Western central banks remain distracted by interest rates, inflation reports, and bond markets, while quietly overlooking the growing strategic importance of physical silver supply. While the West debates policy, China steadily secures critical resources, reducing reliance on systems it no longer fully trusts. Silver export controls mirror earlier restrictions on rare earth elements and strategic minerals. Each restriction fragments global supply chains, increasing inefficiency, costs, and geopolitical tension. The age of cheap and abundant raw materials is rapidly coming to an end. The $63 silver target is not speculation, but a recalculation of future supply under tightening global constraints. At these prices, many manufacturers face shrinking margins or complete operational shutdowns. Yet silver demand does not disappear. It becomes more urgent and less price-sensitive. This desperation drives further volatility across futures, spot, and physical markets. The result is a feedback loop of fear, hoarding, and accelerating prices. Retail investors begin noticing warning signs long before official headlines acknowledge the crisis. Physical silver premiums rise far faster than paper spot prices. Delivery times stretch from weeks into months, frustrating buyers worldwide. Some dealers quietly limit purchase quantities, fearing inventory exhaustion. These signals rarely appear simultaneously unless physical stress is severe. Mining companies cannot respond quickly to sudden demand shocks. New silver projects require years of exploration, permits, and capital investment. Environmental regulations further slow production expansion across multiple jurisdictions. Most silver is produced as a byproduct, limiting miners' ability to scale output independently. Supply remains rigid while demand accelerates. This rigidity hands China a powerful strategic advantage. Domestic manufacturers enjoy stability while foreign competitors absorb chaos. Cost certainty becomes a hidden weapon in global competition. Market leadership shifts quietly but decisively toward Asia. Many investors underestimate how quickly commodity leadership can change. Mainstream media initially downplays the silver story. Attention remains fixed on stocks, interest rates, and political drama. Yet beneath the noise, silver fundamentals deteriorate rapidly. Institutional money quietly positions before the narrative changes. By the time headlines shift, the opportunity window may already be closing. Historically, silver remains calm for long periods before erupting violently, catching investors off guard when suppressed pressure finally releases. When silver breaks higher, it rarely moves gradually, often leaping in sharp, aggressive price surges. China's export halt may represent the catalyst that finally ignites this long-anticipated breakout. Years of accumulated imbalances now collide with a sudden supply shock. The result could be a repricing event rather than a normal market rally. Geopolitically, silver export restrictions add pressure to already strained Western alliances. Energy transition plans depend heavily on stable silver supply chains. Delays in silver access threaten climate targets and political credibility. Governments face uncomfortable trade-offs between cost, speed, and strategic dependence. Economic reality begins overriding political promises. Some nations attempt emergency silver stockpiling to avoid industrial disruption. Others pursue bilateral supply agreements outside traditional markets. Each urgent purchase pushes prices higher, reinforcing panic behavior. Market psychology shifts from complacency to fear. Fear accelerates demand faster than fundamentals alone would suggest. For decades, silver was considered abundant and unthreatening. China's export halt exposes that assumption as dangerously outdated. Above-ground silver stocks are far smaller than commonly believed. Consumption continues to outpace replacement year after year. Scarcity transitions from theory into observable reality. Investors now face a defining strategic decision. Ignore silver and risk missing a structural revaluation. Prepare early and manage volatility to capture long-term opportunity. This moment is not about short-term trading. It represents a fundamental reset in how silver is valued globally. China's actions are patient, calculated, and strategic. Every ounce kept domestically strengthens internal industrial power. Every ounce withheld tightens pressure across global markets. Leverage increases quietly, without headlines or celebration. By the time the world reacts, the balance of power may already have shifted. The silver market rarely provides clear warnings, but this time, the signals are flashing unmistakably across global supply chains. Exports stop, inventories shrink, and demand refuses to slow. Markets can ignore fundamentals temporarily, but physical shortages eventually force price discovery. Silver pricing now moves closer to reality rather than financial illusion. The question is no longer if silver reprices, but how violently it will happen. Analysts increasingly cite $63 as a conservative equilibrium under restricted supply. At this level, decades of artificial suppression finally unwind. Short positions face mounting pressure as physical demand overwhelms paper markets. Forced buying accelerates the upside, feeding a powerful squeeze. What begins as hedging quickly turns into panic. Institutional capital floods into silver to protect purchasing power. Retail investors follow, driven by rising premiums and limited availability. Coins disappear, bars sell out, and delivery delays stretch even further. The disconnect between paper prices and physical reality becomes impossible to ignore. Trust in paper silver instruments begins to erode. Some exchanges tighten rules to maintain stability, others raise margins, forcing weaker participants out. Volatility spikes as liquidity thins. Meanwhile, industrial users face impossible choices. Pay higher prices, pass costs to consumers, or halt production. These costs ripple through the global economy. Inflationary pressure quietly intensifies. Central banks confront yet another challenge they cannot print away. Strategic metals expose the limits of monetary control. Silver reasserts itself as both industrial necessity and monetary hedge. China's export halt reshapes markets without firing a single shot. Economic warfare increasingly replaces traditional conflict. Silver becomes a quiet battlefield of the new global order. Those watching closely see opportunity hidden inside volatility. Those ignoring the signal may soon face a market they no longer recognize.